Just hearing there about the Japanese story, the role that Japanese bond markets are playing is a really interesting one right now. Looking at the US Treasury market, though, 4.6% on the 10-year. We spoke to a guest earlier on who was talking about, this likely to go to 5% in his view, and even that might not encourage him into the market. How are you thinking about the global bond conversation at this stage?
Well, first of all, in a longer-term view, I completely agree with that guest. I think ultimately yields are going a lot higher. I just think this does not happen rapidly or in a straight line. I've had that view for the last, number of years, and I think we're going into a much higher range, and that plays out over years. And the reason that is that ultimately there are a lot of people who are income collectors who will basically seize jumps in yields as a chance to just buy into long-term bonds. So the kind of transition to a higher yield environment takes place over months and if not years. But I think we do need to move into that world. In the short term, I don't think bonds are quite out of the current sell-off just yet. We've paused in the short term. I think some of the political concerns in the UK have damped down a little bit with, the comments from Andy Burnham last night about being a little bit more fiscally restrained or expressing sentiment in that regard. And also Trump, again, providing some people, who I think real optimists out there, that there might be a diplomatic solution to the Strait of Hormuz. So it's temporarily paused, but I think this sell-off has more to go in the short term. Then we'll get those dip buyers in bonds. But later on this year, we'll see much higher yields again.
How do stocks do if yields are going higher over the long term?
So I actually think that stocks can cope okay with higher yields if it's for the right reason. If that's because the economy is doing really well, then that's actually okay. Now, the problem is we have higher yields for some good reasons. There is a relatively resilient and strong economy, and we've got a lot of spending in the AI space, which is driving the K-shaped economy or supporting the K-shaped economy. But we also have higher yields for a lot of bad reasons. We have the supply side inflation shock, which isn't being resolved, and we have fiscal concerns. So that's an image to say that I think it's going to ebb and flow. Ultimately, higher yields are bad for stocks, but it's maybe less dramatic kind of at some binary level. I will say, though, given the move higher in yields of the last couple of weeks, I actually think right now bonds are closer to the dip buying moment than stocks. We talked about this yesterday. I think we're now in a couple of weeks where stocks can retrench a bit, only in context of the extraordinary gains. This is not the end of the bubble. The dip will be bought again, but the dip won't be bought that quickly.
Mark, I was going to follow with that, with what the dip buying impulse will be, particularly when it comes to the semis and the sell-off that we've seen in the US and Asia today as well. You think that could happen, but maybe at a more moderated pace?
Yeah, I just think you've got to put it in context of two things. One is we've just seen extraordinary gains. So quite sizable headline pullbacks will still leave us like massively up on any reasonable look back window. So it's not kind of blowing up this bubblicious bull market we're seeing in this sector. We've also got just massive herding because everyone's using the same AI advice for these trades. So that's why I think it can be quite painful. It'll clean out the first initial dip buyers who then get cleaned out. So maybe this lasts a few weeks this time.